Risks in capital markets. Capital markets are financial systems in which investors can buy and sell equities, bonds, and other securities. They provide a way for businesses to raise equity and debt capital for operations or investments. With the potential rewards come risks associated with investing in these markets. Capital market risk is defined as the possibility of an investment's return not meeting expectations due to changes in economic conditions, such as interest rates or political events, like wars or elections. There are several types of capital market risks that investors must be aware of before entering into any transaction. These include economic risks, such as interest rate risk, inflation risk, and exchange rate risk. Credit risks, such as default risk and recovery risk. Market liquidity risks. Political risk, such as political instability risk and regulatory changes risk. Technological risk, such as cybersecurity and data security. And other risks, such as opportunity cost risk and legal risks. Economic risks. Economic risks are one of the most important types of capital market risks that investors must consider before entering into any transaction. Economic risks in capital market includes interest rate risk, inflation risk, exchange rate risk, and sovereign debt default risk. Interest rate risk relates to the possibility that changes in interest rates may cause a change in an investment's return. Inflation risk is another key economic risk associated with investing and refers to the potential for rising prices to decrease purchasing power, leading to lower returns on investments over time. Exchange rate risk is also a major economic concern when it comes to capital markets, as fluctuations in foreign currency exchange rates can significantly alter a portfolio's value. Lastly, there is sovereign debt default risk, which occurs when governments fail or refuse to make payments on their outstanding debts. Credit risks. Credit risks refer to the possibility that an issuer of a debt instrument may not be able to make payments on time or in full. Credit risks in capital market includes default risk and recovery risk. Default risk is the primary form of credit risk, which occurs when a borrower fails to pay back their loan or obligation in accordance with its terms. This can cause investors to suffer financial losses if they are unable to recover their principal amount plus any accrued interest or other benefits associated with the investment. Recovery risk is another type of credit risk that arises when lenders try to reclaim funds from a borrower who has failed to meet payment obligations. This can lead investors into long legal battles over disputes about repayment, making it difficult for them to recoup their original investments and causing additional distress in the capital markets. Investors should always thoroughly assess potential investments before entering into transactions and consider these types of risks so that they can better manage their portfolios accordingly. Market and liquidity risks. Market risk refers to the potential for an investment to lose value due to factors beyond your control, such as economic conditions, political events, and natural disasters. Investors may experience large losses if they buy or sell assets at the wrong time, and this kind of risk can have a significant impact on portfolios. Market and liquidity risks in capital market includes price risk and liquidity risk. Price risk is also important as it relates to fluctuations in pricing over time, which can lead to losses due to unexpected changes in value. This kind of risk is especially pertinent for investors who hold assets for long periods, since prices tend to move up and down unpredictably over extended periods of time. Liquidity risk refers to the difficulty of buying or selling a security without significantly affecting its price level due to lack of available buyers/sellers at any given moment. Therefore, it is important for investors to carefully monitor their assets and stay abreast of any developments related to them so they can make informed decisions regarding their investments. Additionally, diversifying portfolios across different asset classes may help reduce the overall level of market liquidity risks posed by individual investments. Political risks. Political risks are another type of capital market risk that investors should be aware of before investing. Political instability risk is the potential for a government to experience significant changes in power or policies that could significantly impact investments and their related returns. This kind of uncertainty makes it difficult for investors to predict how their portfolios may perform over time, so they must remain vigilant with regard to any news regarding political developments, in order to adjust their portfolios accordingly. Political risks include regulatory changes risk. Regulatory changes risk relates to the potential impacts new regulations and policies can have on investments or entire markets. Changes made by government entities, such as central banks, capital market authorities, or tax authorities, could significantly alter how assets are treated under certain laws and regulations, which could lead to dramatic shifts in prices across all kinds of securities traded within capital markets. As such, investors should always be aware of any news related to regulatory changes, so they can adjust their strategies accordingly and minimize disruption caused by unexpected developments outside of their control. Technological risks. Technological risks can pose a significant threat to investors in capital markets and must be taken into account when making any investment decisions. Technological risks include cybersecurity risk and data security risks. Cybersecurity risk is one such type of technology risk that arises from malicious actors attempting to gain unauthorized access to systems or data. This kind of risk has become increasingly common in recent years, due to the growing sophistication of hacking tools and techniques, making it essential for investors to take proper measures to protect their investments from potential cyber threats. Data security risks are also important considerations as they relate to protecting confidential information stored on computers or other digital devices. If an investor's data is not properly secured, then malicious actors could gain access and use it for nefarious purposes, leading to financial losses or reputational damage for the affected individual or organization. As such, investors should always ensure their data is adequately protected by employing strong password protocols and regularly updating antivirus software, among other measures. Technology-related risks also include those associated with new developments within certain industries that may have impacts on capital markets investments. For example, if a major technological breakthrough occurs in the medical field, which significantly alters how treatments are administered, this could lead pharmaceutical companies' stock prices to soar, while causing declines in related sectors like insurance companies, which may no longer need as many policies covering these kinds of treatments anymore. Thus, understanding how technological advancements can impact different types of investments can help reduce overall exposure levels for portfolios investing across multiple asset classes in order to maximize returns while minimizing losses from market volatility caused by unexpected changes coming from outside sources. Other risks. This includes opportunity cost risk and legal risks. Opportunity cost risk arises when investors forego potential returns by choosing to invest in one asset over another. For example, if an investor decides to invest in stocks instead of bonds, they may miss out on higher expected returns from the bond market and suffer losses as a result. Therefore, it is important for investors to carefully assess all available options before making any investment decision so they can maximize their potential gains, while minimizing losses due to opportunity costs. Legal risks refer to issues relating specifically to legal disputes between parties involved in trading activities within capital markets. Disputes can arise due to misunderstandings about terms and conditions or failures by one party to meet its obligations under agreed-upon contracts. These kinds of disagreements can lead investors into costly court battles, which can take up considerable amounts of time and resources, with no guarantee that favorable outcomes will be achieved for either side. Thus, it is important for investors involved in transactions within the capital markets to ensure all relevant documentation is properly reviewed and understood prior to entering into any deal, so as to minimize potential losses from legal disputes down the road. Conclusion: it is clear that understanding and managing the various risks associated with investing in capital markets is essential for any investor seeking to maximize returns while minimizing losses. Although these risks can be daunting at times, there are strategies available to mitigate them, such as staying up to date on regulatory changes and ensuring all necessary documentation is properly reviewed prior to entering into a transaction. Additionally, investors should always remain aware of technological developments, which may have an impact on certain asset classes, so they can adjust their portfolios accordingly. By taking steps such as these, investors can protect themselves from potentially costly mistakes when participating in capital markets and ensure their investments are well positioned for long-term success. Thank you for watching. Hope to see you all on the next one.